It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast. Yes, breaking down for you the property market piece by piece. Nice to get Monday out of the way. And if you've got a friend who's trying to learn, just like you, as much about the Aussie real estate property market with everything that is unfolding and going on, be sure to let them know about us, because just like you, they can join the conversation through our voice messaging service. Great service. All you've got to do is press the button, you start talking. If you don't like the way that you sound, just re-record it as many times as you like before you send it to us, and we will add your voice onto the many voices we are talking to every week. Or if you would like to do the email, yes, that is still available for you, myrealestatepodcast@gmail.com. Well, it's a Tuesday. It is August the 18th. Now, if you are tracking home prices, here's an interesting stat. Even if property values crashed 20%, markets like Perth, Brisbane and Adelaide, they would still hold on to their massive 5-year boom gains. But it is a completely different story being touted about Melbourne. A 10% drop pushes values back to pre-pandemic levels. And the ANZ is predicting that a major slowdown. There is a warning for Sydney, and that warning is that Sydney could plunge by over 14%. Really, 14%. I guess time is going to tell us whether that is a reality or not. Let's take you to Brisbane right now and catch up with Asti Mardiasmo, the PRD's chief economist. And welcome back, Asti, onto the Real Estate Breakfast. Yeah, first question I want to ask you is, what do you think about that 14% coming off in Sydney? Or would it take another global financial crisis for some of these numbers to actually ring true?
Hello there. It is definitely quite a worrying figure, especially because we haven't seen Sydney have that sort of downturn in the market for quite some time. But I truly think that, it will take something quite big, like a global financial crisis, for it to plunge to that 14-15% decline in prices, simply because we have had higher interest rates in the past 6 months. We've had, 3 cash rate hikes. Expectation is that we will continue being on a cash rate hold because the inflation rate has been declining since March 2026. And this is something that the RBA did not expect. They thought that the inflation rate would go the other way, but in fact, it's actually been declining steadily since March, and we're at 3.8% as of June quarter.
Yes, and let's circle back to Sydney, because over the last 6 months, it has taken over that time 5% to come off the property market there. That's the point in case, isn't it, in terms of some of these numbers, I guess?
Definitely, and it's because we have seen not only, the strong Sydney market decline slightly, but also that we have seen some drop in auction clearance rates. So I think that's where these sort of predictions would have come from. But at the same time, that has taken 6 months. It's not an overnight drop. It's not even like, within 30 days, a quarter type of drop. It has taken a slow burn in terms of actually dropping. So to drop it even further by another 10% from that -5, even if, for example, we're not in the situation where the cash rate is being held steady, it would still take time. It wouldn't happen overnight or within 30 days.
Yeah, let's talk about the investors, Asti, because this is an area that you're heavily looking, you're monitoring, you're seeing the day-to-day movement. Investors at the moment, they just can't sit back and wait for that perfect house anymore. What's some of the thoughts around what investors should be doing at the moment, where we are in the cycle of the property market right now?
I'm not going to dismiss that there has been some fear and some changes when it comes to investment and investors, because the federal budget did shake it up quite a bit. But at the same time, it doesn't mean that there aren't any opportunities, because investors can still access negative gearing if they were to go into purchasing a new build. At the moment, there are definitely quite a lot of new builds that has been constructed or is being constructed. Negative gearing, if you already had the property before budget night, it's grandfathered, so you are protected, which definitely brings still some opportunities into the market. We also have to remember, Craig, that investors, it's not just a capital city area that you should be looking at for investment. There's also positively geared properties and new builds in regional areas as well.
Yeah, and here's something for you, because you're part of the media. Just about every person that I am talking to from the real estate industry always sort of saying, the media have got such a negative spin on what is happening at the moment. And national headlines, for that reason, they can be misleading for people, especially if you're looking to buy in a particular suburb. Your suburb that you live in or you are thinking about buying into, that might be telling a completely different story. So two things can be true at once. What a lot of these real estate people are saying, yes, there are some negative connotations around what some of the media headlines are, but you've really got to sort of break that away from different areas, different parts of the market.
Oh, absolutely. And it's the using of the words that, from an economics behavior perspective, scare some people when it comes to the real estate market, especially when, the words recession or a property crash is being used. If we actually look at the figures, even Sydney, for example, at the moment it declined by 5%. However, if you've held a property in Sydney, say for the past 10, 15, or maybe even 20 years, then you would have netted around more than double or even triple the value from when you first bought the property. And so a 5% decline still means that you're still actually netting quite a lot of profit or capital growth in the past years that you've, accumulated that capital growth since you bought it. Brisbane, for example, in the past 12 months, median house price have grown by 14.8%. And Adelaide and Perth is also in double-digit percentage growth. Adelaide by about 20% and Perth by about 17%.
And we are talking to Asti Mardiasmo. She is in Brisbane, as she says. We are back with more after this.
Don't forget to subscribe. We have so many episodes, all designed to help you better understand the constantly evolving and dynamically changing real estate property market. We dive deep into topics like buying, selling, investing, and maximizing your property's value, from mortgage advice to the latest property data and trending numbers. Your real estate journey starts here.
Well, last week, as we know, the RBA decided to just hold things, but they are predicting that home prices will keep drifting downwards. This is from the RBA, but don't expect them to cut interest rates just to save the property market. The Governor, Michelle Bullock, says that her focus is entirely on inflation risks like construction, labour shortages, and in fact, the banks and economists, now they see a 60% chance of another rate hike before the end of the year. So yeah, as I keep saying, there is a long way to go before we are out of the woods. It is a Real Estate Tuesday. We're talking to Asti Mardiasmo in Brisbane. Time to have a look at these units, Asti, because they're becoming harder and harder to ignore. Most people have sort of realised the fact that, yes, there is such an upside to getting into the unit market because of where we are. They're cheaper than houses. Rents are becoming more attractive. And in some cities, they may simply be the most realistic entry point for buyers.
Definitely. If we compare the median price growth between units and houses, they've become quite similar in the past 24 months or so. In Brisbane, for example, the median unit price is around 850,000, whereas the median house price is at 1.3 million at the moment. And so that is definitely a much cheaper entry price into the property market. And as I said before, median house price growth was 14.8% in the past 12 months, whereas median unit price growth is at 12.8% in the past 12 months. And so it's quite comparable in terms of the capital growth in the past 12 months, but, at about 30% cheaper.
And buyers agents, boy, has this been a talking point this year, because so many buyers agents are getting into the market, people that have never worked in the real estate market. So the changing role of a buyer's agent, this is forever changing with people looking to buy, because it's not simply about finding you a property. Their understanding and their guidance for you into any suburb across Australia is so vital. We're talking about the numbers. What is being built nearby you? What are people paying? And whether the whole deal actually makes sense. Be very, very cautious when you are engaging buyer's agents, because the top buyer's agents that we talk to, they are warning about some of these fly-by-nighters, some of these buyer's agents that don't have the depth of experience. So it's a question, buyer beware.
Absolutely. I think the role of anyone in the real estate industry at the moment, whether it's a real estate agent or a buyer's agent, is significantly changing to not just a helper in making the transaction happen, or, someone to assist you with filling out paperwork anymore, or showing you a home. We're becoming more like educators, really, and having that knowledge of what has been happening in the suburb, not just the past 12 months growth or the past quarter, but even going back to 5-7 years sort of like capital growth, because obviously most investors and homeowners want to know the long-term sort of perspective, not just the snapshot short-term perspective. Also knowing if there's any new infrastructure, new development happening, new commercial businesses, new industrial warehouses. So really doing that holistic analysis of not just about the property and what will happen in the suburb in the next 24 months, in the next 5 years, in the next 7 years. And I completely agree. Whenever I talk to anyone in the public, so to speak, whether it's a first home buyer or an owner occupier who wants to upsize or downsize, or an investor, I always ask them, if you're talking to a buyer's agent or anyone in the real estate market, ask them, do they know what is the rental yield in this particular area specific to the suburb?
Yes, and yesterday, just before I let you go, I was talking to Margaret Lomas, and she sort of raised the question, because I was throwing it out there that it's very hard for economists, and you're one of them, to kind of predict what is happening in this market where we are with so much going on. She threw up a stat that, yes, 50% of the time economists are wrong. That is without these massive geopolitics that are going on. It's very hard at the moment for economists to get it right. But as she said, more often than not, they know a lot more than anybody else does.
I think with us economists, it's about weighing up the modeling we are aware of, whether that's from an interest rate perspective, and of course, what the government is doing as well, and all of the incentives that they're bringing out and some of the new ruling. But at the end of the day, I think it's more about being able to say, look, this is what's happening in the market. It's not about following trends. It's about knowing what is best for that individual based on their financial position at the moment as well, because the market could be doing what the market is doing.
All right, good on you there, Asti. Keep on doing what you're doing. As far as trying to read the market, it is not easy at the moment. But thanks for coming back on to the Real Estate Breakfast this morning, and enjoy your Tuesday.
Thank you so much. Until next time.
We connect you to the best real estate information across Australia. The Real Estate Podcast.